Assalamu alaikum ji. My name is Salman Zaidi, and me and my partner Rehman Zafar are here to kind of like go over a little bit of our uh, our personal journey, and then touch a little bit about what we have learned and have find out as sort of like a gap in terms of what we thought or understood to what we do now. So anyway. I started my software career back in '95. We started the software career as well as a number of businesses at the same time. Trading was one of the pastimes that I kept engaged in Lahore, and then when I came to US in '98, I witnessed the crash of 2001, and then the financial turmoil in 2007, 2008, and although all that was a passive witness, as I was not really dependent on the market to produce the income, or I was really never looking into doing it professionally. I was doing it always as passive side investment, whereas my job was already something that I was doing. So come 2015, I took a little bit of hiatus and for 5 years, and 2019 end, I started looking back into what I want to do again, and this was securities came out to be something that I found myself to be passionate about for the last 20 some years, and I'm like, okay, well, maybe this is something where I need to start a career. So I restarted at that time. The journey kind of like led me and Rehman finding out that we both want to do this. So Rehman joined my journey there, and we both went to educating ourselves. So we said, okay, there is a gap in our understanding. First, we have to kind of like identify and bridge that gap a little bit before we kind of like lead others onto onto something that we feel is appropriate for that particular point in time. So we both, me and Rehman, we went for our Series 65 exam, that is the securities licensing. And thank God we both passed about 2 weeks ago, June 19th and June 21st. So now comes the next step of where our last one and a half year of dabbling into the global markets has led us in terms of understanding, as well as this education, where this has led us to understanding where we are in terms of how we manage our finances. So with that prelude, which was a long one, I would lead the talk into Rehman. Rehman, please take over. And
thank you. Yeah, so I just wanted to, when I was thinking about this presentation, right, I was thinking, well, we're going to talk about money. Money is a very boring topic. It has sometimes, it's scary. Some people have different feelings associated with that, secretive. Sometimes it is, I don't know, there's a bad feeling given to us for whatever reason. It is associated with the greed and all those kind of negative notions, right? So we don't normally feel comfortable talking about money or finance. And this is the first thing which I think this is part of our learning as well, that we should not be scared about money. We should be talking about it, and we should be, because our lives are actually driven, or we are striving for, and they are kind of engaged through the money as well. So, and then I thought, what are the, I mean, I don't know what is the audience level of understanding of the finance and all that. And I thought if we just go back to the basics, right, in terms of some basics understandings of the money, how it works, how it's kind of should be structured and all that. I thought that would be nice. And then I thought because we come from a technical, majority of us from the technical background, and I thought it would be nice to use an analogy of design, because for we all of us, more or less, I think we understand design, and design means that you got to have a blueprint of your of the product you're going to be building, or the end product you're going to be, an article you'll be finishing. So you got to have the design so that you can start putting effort towards that, and design has to be based on certain principles you can apply on. And I thought that would be a nice way to start from there. So that's why I chose the title of this presentation is a financial design for life, and that is kind of a question for everybody else to understand that do they have it's a prompting question that do you guys have any design or any planning for the financials or the finances you're going to be managing in your life as well. So that is the understanding of this. I'm going to move on to the next slide. Yeah. So this is a cash quadrant which I borrowed from I don't know if you guys have heard Robert Kiyosaki is a very famous cash quadrant he talks about, where he divides people into 4 different categories. There are employees, which is E, and then the employees are simply trading their time for money, and once you stop putting the time, you stop the money, simple as that. And then you become self-employed as well, where you have a kind of bit of a you're still working for, you're still trading time for money, but it is kind of a, maybe you can get some tax advantages on that. But in both cases, you are trading time for that. And then as a business owner, as we all know, that you start managing people. So that means more people are working for you. So that means your time is multiplied, and obviously you're going to get the money for you. And then in the end, which the last, according to Robert Kiyosaki, is that you got to be in the investor category, where you don't have to, where money should be working for you, basically. So you don't have to put your money, you don't have to put your time into it, but the money should be working for you. And ideally speaking, everybody should be striving for that category, where when it doesn't matter whether you're part of that equation or not, the money should be working for you, the income should be coming to you, and then your financial design or the financial planning eventually leads up to this point where you can have some, where you have to remove, even if you have to remove from the situation, you should be able to make the money. So that goes back to the goal setting. The very first point I wanted to make is that everybody got to have a goal setting. Unless you do the goal setting, obviously, it's not going to happen, just like any other thing. And goal setting, and this statement about the first statement, which I'm talking about, a net worth, which is equal to asset minus liability, that is the more, it's very simple, but that's what finance is all about eventually. Your net worth is all about what assets you have minus the liability you got, and that is your net worth. And then over the period of time, you should be reducing your liabilities and you should be increasing your assets. And those assets could be, I mean, there's a whole debate about the whole categories of assets over there, the short-term assets, long-term assets, but the idea is that eventually your assets should be increasing over the period of time and your liability should be reducing. And any liabilities you're going to be keeping, hopefully those should be coming from the income you're generating from your assets, and you should be paying off your liabilities. And then financial goals, everybody got to have, and implicitly or explicitly, even if you don't have it, we are forced upon those goals as well. Somebody got to go to school, somebody have to go to get married, I don't know, sending children to the school, whatever the life stage they are in, they got to be having those goals as well. And then earlier, the point is, earlier you start thinking about those ideas, right? Earlier you're starting about thinking about those goals, you have more time to get to this category of investors, or the I we're talking about, because most of us, I believe, are coming from the employment background or self-employed, or maybe we have started some business over the period of time. But eventually, once you start setting those goals, that in 5 to immediate goals, midterm goals, and long terms, they got to be in place. And then based on those goals, obviously you got to find the suitable investments for that as well to match your goals as well. So some should be for the short term, some to long term, and medium terms as well. And the last point which I wanted to make. This is all part of that design of the scaffolding I was talking about, the skeleton you need to put in. And tax planning is very important as well. And tax planning can be categorized for your capital growth. How are you going to most tax efficient way you can grow your capital, and how you're going to retire. And then obviously inheritance is part of it as well, that how you're going to pass that money to your loved ones when you passed away without in the most tax efficient ways as well. And then if you start thinking about those things, right, in those terms of this will the foundation of your financial planning, and then you can find the suitable. And every investor obviously has their own appetite for risk and everything, and that you find your investments accordingly as well. I'm going to stop. You can stop me anytime at any point in time. If you have any question, you can stop me and let me know as well. So any questions so far on this one before I move on to the next one? Okay, that's fine. Okay, this is about I wanted to touch upon the risks, basically. Just like I was mentioning that money has a negative connotation, right? In our mind, sometimes risk is also considered to be negative, has a negative connotation as well. Risks are everywhere, basically. There are different types of risks. We face them every time. We face them every day, whether we like it or not. There are it can be systematic risk, they call it, or non-systematic risk. So you can have a market risk, which is if the whole market goes down in certain circumstances, political regime changes, regulatory changes. These are systematic. You cannot do anything about it, right? You just put your vote into the political system, but the consequences are either intended to you, are intentional or non-intentional, but you will have the consequences of that. And sometimes you have a control on that. Sometimes these kind of systematic risks, you don't have any control on those as well.
Rehman, your audio is getting interrupted. So if you stop your video, maybe the audio would come through okay.
Okay, let me stop my video. Just give me a second. I'll stop my video. Stop video. Is it better? Is it better now?
Yes.
Okay. So the systematic risk, the political, regulatory risk, you can't control it, right? And we always face risk, right? Sometimes we think we are very risk averse, we are doing a nice job, a cushy job as well, but we are still in a business, and that business is subject to all sort of risk which you just talk about. The business has an inherent risk as well. So if the business, as we all know, you guys, American hire and fire policies, right? Every time people get hired and fired, and that is based on the risk they are facing from the external market, and you have no control on that. So we always face risk. But the question is, how many risks you can actually control and diversify, right? That's where the game starts, basically. When you start thinking risk from that point of view, all right, these are the risks I cannot control, and these are the risks I can probably diversify. That's where you start planning in a systematic way, and you can diversify those risks with your financial planners and with your investment advisors, and then you can start putting the plans accordingly to diversify those risks as well. So those risks can be managed as well. So the things which cannot be managed is fine, but the more risk you have, you should be able to control those non-systematic risks to your side as well. And then risk is always proportionate to the reward as well. So you have to understand in your mind, the risk I'm taking this one, what is the reward against that? So if you are taking the higher risk, you should be expecting higher reward as well. So you always equate yourself with risk and reward ratio as well. If the reward is not proportionate to the risk, then probably that risk is not worth taking. And similarly, if the reward is, and vice versa as well. So, so that what I'm trying to explain in this presentation is that risk is not bad. Risk is manageable, and more risk which we can manage, better it is, basically. And if we don't that another point, the flip side of it, right? If you don't take risk, right? If you don't manage the risk, and then because you didn't take the risk, that means you cannot get the reward as well. So that means the losing of the reward, which you could have taken if you have taken the risk, then that is also an opportunity cost, because just because you didn't look at the risk properly, you didn't mitigate it, you didn't go into that direction as well. That means if there was any reward which you have lost, then that is an opportunity cost which you have to pay for not taking the risk as well. So is that clear for everyone? This side? Okay. Any questions so far? Okay.
No questions.
Thank you. Another thing which I wanted to talk about is about markets. It's a daunting place, right? When we talk about markets, we talk about, oh, this is complicated. There's so many products over there, where to start and all that. That is all good. And this is all varied factors, basically. It's a very daunting place, and people don't know where to start and how to start. But if you think, again, just like I talk about the risk, if you think risk markets as well, these markets are there to, it's a $1 billion trillion kind of organization, right, around the world, trillions of dollars. And if you think from that point of view, those trillions of dollars are, they are there to serve you, basically, because if they're giving you the opportunity to participate, they're giving you the opportunity to participate in a $1 trillion industry with probably very minimum cost as well. So that is the beauty of the market as well, that they are there to serve you, and it's up to you. How do you, if you're smart, how do you make it work for you as well? And people obviously, that's where the strategies come into the place. That's where you have different professional advisors helping you out in that. But that's where it's come down to that they are markets which are there to serve you, basically, and they are driven by competition and pure innovation, ingenuity as well, because all these corporations, right, who are in the market, their driving force is pure competition. They wanted to get more and more capital. They wanted to have a growth. They wanted to build new products as well. So for all that capital which comes to the market goes back into those companies. If they have a smart management, obviously, then it goes from strength to strength, basically. So it drives competition, which is always good. It drives, you get better products into the market as well. You get better services. And as you can see in the last 10, 20 years with the technology, I mean, we all from the tech background, we've seen our lives have been transformed. And one of the driving forces is the markets, basically, for that. Another thing which markets provide you is a global reach for your capital. You are sitting in your drawing room and you can invest a company in China or a company in Japan or US or in emerging markets as well. So depending on your risk appetite, you sitting from your living room or working with some financial advisor, you can make your capital work around the world. So otherwise, imagine if you have to start a business somewhere in Southeast Asia, right? How difficult is that for you to go over there, find a market, find a product over there, and do some investments and all that? But all that is made available to you through markets to you. And that's why I always say they are there to serve you. And normally, and this is another third point is quite important, the equity investments, right? The shares we talk about in general terms, they generally beat the inflation on the long term. So if you, in a mature market, I would say, right, then your equity investments are generally beat. That's generally beat over the long term, the inflation which is happening. So it is always wise to understand from that point of view that your capital is always at the risk of losing the buying power if it's sitting idle. So you have to make it work for you, basically. And also in the markets, there's always something for everyone. based on the risk tolerance and the time horizon they want, whether they want to generate an income over there, or they wanted to grow their capital, or they wanted to find good companies to invest in the long-term horizon, or they wanted to they wanted to invest, but also they wanted to keep the liquidity in terms of they wanted to get the money as soon as possible as well when they need it. So all those kind of possibilities are there. It's just that how you structure your, as I said in the beginning, how you plan it, how you design it, and how you go about it, basically. Any questions on the markets? Okay. Then I wanted to touch upon the different investment categories, right? I mean, there are thousands and thousands of derivatives and products as well, right? And it is very, as I said in the beginning, it's very confusing where to go, what to find, and all that. But if you just take a very high level, macro level approach, right? There are only two types of products, and rest are all derivatives from these products, basically. There are only two types of investments, and rest are just, if you remember, the rest are just the derivatives of these types. Either you're investing in equities, or you're buying a debt, or you're giving a loan to somebody to get the money against the debt as well. So these are the only two types of investments categories you have, and the rest is all derivatives out of that, basically. So equities, as we say, mostly they are growth oriented, right? As I explained to you, if you and you can still earn the money on them as well. If there are companies, there are stable companies like utilities companies where you they are, I mean, they're there forever, basically, and they are dividend paying. So if you invest into them against your shares, you can get the dividend, so you can generate the income from that point of view as well. But generally speaking, you wanted to be part of you wanted to get the ownership of the company. You get the voting rights as well, and the shares as well. And also, you wanted to be part of the growth of that company, so that when the company grows over the period of time, your share values, your equity grows with that company as well. Your capital is growth as well. The capital is grown as well. So generally speaking, you are part of the growth of the company. You are the owner of the company. It doesn't matter if you even if you have one share of the company, you are the owner of the company. That's it. If you have to think it from that point of view. You have the voting right as well. If you are a common shareholder, you have a voting right for that company as well. So you are, again, that's the beauty of the market. The market gives you an opportunity to own the companies. It doesn't matter how fractional that share is, but still you can say, if you buy a Tesla, you can see I own Tesla, right? Even if you have one share of Tesla, it is the ownership, right? And you have the right to claim that as well. And the other flip side of it is the debt. That is where you give your money again, just like you give the money in equity and you buy the ownership. In that, you give the money, you expect the money back from the company. Your capital should be expected, you want it back after a certain period of time, basically. So that goes into different kind of bonds, basically. Your capital is preserved because you're going to get your money back. Mostly they are interest bearing as well. So you could have corporate or government bonds as well, depending on the rating and the maturity and the risk you want to take. Some are AAA bonds. So there are companies which rate the bonds based on the stability of the companies and the ability to pay back, basically. So there are ratings against those bonds as well. So you can choose the stability and sometimes if you are what we call it junk bonds are lower rated bonds. You get more yield on that, but but the chances are that company might go bust, right? So that is the dangerous side. But that is the dangerous side on equity as well, that if the company goes bust, then you can lose the capital anyway, right? But depending on the maturity and depending upon the risk rating, you can pick and choose depending on your risk appetite as well. And majority of these debts are interest bearing, so people from the if you're talking about halal investments and all that, obviously that is something questionable from the debt point of view. Just give me a second. I have to close the door. Yeah. So that is, you have to see. But then different, there are government's bonds as well. You can buy the government's bonds, and they have different maturities as well. They could be within a year. They could be 5 years. You could be 10 years, and that depending on the goals you want to have. And some bonds. This is zero coupon bond. These are I wanted to especially mention these bonds over here because we just talk about the interest. On zero coupon bonds, you don't get any interest basically. That is simply you giving the money on a discount. Let's say you give £900 and you say, I'm going to give £900, but after 5 years of maturity, I'm going to get the £1,000 from you. And that's about it. You don't get any interest. You don't get anything. You just loan the money and you just get a premium on that money once you hit the maturity of that. So, and these are the two major categories of the investments basically. And then when government monetary policies changes, right? When let's say interest rate goes up and down, your Federal Reserves changes their policies as well. Then the capital flow from equity to debt or debt to equity, depending, the rotation happens within the two categories basically. So either people go to the bond market or people go to the equity market, depending on the government policies as well. So sometimes you say when the equity markets are going down, people are buying more bonds. The investment managers more hedging towards the bond side, and similarly when the interest rates goes up, the rotation goes the other way around. So it's always in the flux depending on the government policies as well. Any question on that, guys?
Rehman, a couple of questions came on the chat.
Okay.
So if you see the chat there.
No, I didn't see that. Sorry. I'm just sharing my screen. Where do I see the chat?
I can read them for you. The first question is, which one is better as per your experience, equity or debt, and why? And the second question is, which one's more basically saves you more tax dollars?
Okay. Which one is better than equity or the debt? So that depends on what is your risk appetite basically, and within the equity as well, right? Within the equities, you could have different types of companies. As we know, there are highly rated companies as well, like stable companies. They are S&Ps 500, and also you have big tech companies like Microsoft, Google. They're always there, right? So you always have, I would say, the less risky equity investments as well. And similarly, you have a less risky bond investments as well, basically. But in terms of tax saving, right? And now that's a whole topic altogether. I'm not going to advise. I'm not a tax planner and all that. But what I would say is there are mutual funds which can. There are ways to deal with that. As I said, the tax planning in the beginning, that you can reinvest your capital. And then that reinvestment can lower the lower the what we call it, the base value of your stocks or the investments, but over the period of time that can reduce your capital gain as well. So
okay. Just adding to what Rehman was talking about. From the debt side of the house, the risk appetite. So if you're like an older person who is nearing retirement and has gotten a significant amount of value into whatever investments they have made at that point in time, it is for the risk aversion for that particular age group and what they are looking in terms of the context of their livelihood. They may choose to go into a very high percentage of debt equities because that would guarantee the sort of capital preservation while supplying some income, versus equities being a higher risk perspective at that particular point in time for somebody who is getting into the later stages of life might be lower on the equity side of the house, although that is still something that is debatable in terms of the values that you're keeping for your investments and stuff.
Normally there's a ratio. There's a normal rule of thumb, right? If you are, I don't know, 40 years. If you're 40 years old, right? So they say you should be 60% equity and 40% bond. And so more you get older, you move towards bond as opposed to the equities. So that's, I mean, it's not a, it's a rule of thumb. Generally people say that, but everybody has a different situation.
Yep. And then from the tax efficient perspective, municipal bond funds are usually tax free, but then also you have a lot of tax sheltered accounts, your 401ks, your IRAs, your Roths and whatnot. So depending upon what sort of account, what is the profile of the client, and then what sort of investment horizon you have, you will choose a certain amount of a tax efficient vehicle that is suitable for that particular profile, if that answers the question.
Any other questions? Right?
I think we're good for now. Let's proceed.
Okay, fine. So Salman, you want to talk about, I'm going to share my screen. Can you guys still see my screen or not?
No.
No.
Okay. Just give me a second. Where is it? Yeah, so yeah. So Salman, you want to
Yes,
talk
sure.
about a bit further onto different types of
strategies? Okay, so guys,
yeah.
I will take over here and I will talk a bit about your efficient market hypothesis. So about 40-50 years ago, there was this notion that no matter what you do, no matter how intelligent you become, you cannot beat the market. You cannot do anything that a simple random choice can't do. So
we can't hear you.
We lost him.
Okay, I'll carry on then while he joins. So this efficient hypothesis it says that, generally speaking, that with the law of averages, that you can. Hello. Oh, sorry.
Yeah,
go ahead.
I'm back. Sorry. Yeah. So guys, again, going into the efficient market hypothesis. So the hypothesis states that irrespective of how intelligent or how risk averse you are, or how savvy you have become, or what access to information you have, you can never beat the market. You can never do anything that would beat the market. And there are, over a period of last 40-50 years, there have been many evidences that have been empirical evidences that have been given to prove it wrong and to prove it right. But there are, so it's also called the random walk theory. It's an obscenity over on Wall Street. Most of the people do not want to refer to it or to accept that is true, but it is in every single financial economic book out there, and the theory is true. Nobody has been able to prove it otherwise, that it is not true. Also called the random walk theory. So there are three forms of that theory. The weak efficiency, which is what you refer to as your technical analysis, is the weak efficiency form of this particular market, which says that, hey, no matter what happens on a particular day, anybody who is looking into the past price, which is the very public information of any particular stock or any equity or any particular instrument, the most public information is the past price of that. So you can pretty much go on any source and look into that information, you will be there. So if somebody is looking into the past prices and the past volumes and predicting the future behavior, which is what the technical analysis is, that is the weakest form of efficiency in the efficient market. And they say, well, no matter what you do, technical analysis would never be able to produce the results. Yes, obviously there are exceptions, and you will see some of the evidence against it, but it is always true. So they say we have a technical analysis, but nobody can really beat the market with this. But we need to have a little bit more of the research of some of the data that is hidden. And the next form, the semi-strong says, okay, well, we have some people who will go and dig that stuff out, who will look into the company's income statements, the registration statements, and this and that. So those are your fundamental research analysts that you will see putting ratings onto different stock, but this stock is a buy now, or is a hold now, or is a sell now. So those analysts, what they are doing is they are looking and dipping into the information that is there, that is public, but that is not very visible. So they look into some of the hidden factors. They do some market analysis, they do some top-down, some bottom-up analysis, and they come up with a certain buy or a sell recommendation on a certain stock. But the theory says that still doesn't work, because they don't have the insider information. And the very next one, the strong, says that, okay, well, I have all the technical and all the fundamental research. And
did we lose him again?
Seems like it. So so the strong efficiency means that no matter what you do, even if you have insider information, you won't be able to beat the market, basically, because law of averages will work. So I think the twilight zone is somewhere between research analysis and technical analysis, a combination of both, basically. So you got to come up with the value stocks, and then you understand the recent trends as well, and then you take a bet on that. So that's where we think the twilight zone is. But that is the theory we talk about. I don't know where Salman. Can you guys hear me? Or yeah, right here.
This is all passive.
Okay.
Can you guys hear me?
Yeah, we can hear you.
Yeah. So with the strong efficiencies, so they say just it's better to.
Hello.
Hello. Yeah, we can hear you.
Salman, you're going in and out.
Okay. Is it better now? Can you guys hear me now?
Yeah.
Okay.
So the strong efficiencies, Salman, we were talking about with the strong efficiencies, they say it's better to put money in an exchange trading fund or something like that, or index trading funds, which are they're tracking the indices, and you just don't do anything with that. You just sit down and just ride the wave. As the market goes, over the period of time, you're going to make money as the market makes the money. So that's what strong efficiency is all about. Passive investments, right?
Yes, passive investment. So, and if you look into the empirical evidences on this, the insider information, which you would believe that is a lot more money than anything else, but typically over a period of years has only produced 3%. So from the empirical evidences of the efficient market hypothesis, even insider information doesn't work. So if you do not believe that you are going to beat the market, it is much better to be passively invested rather than doing anything on the active side of the house. So that understanding is kind of like important for people who are doing passive investments, that they are siding with the science in this, that they are with the efficient markets. So moving on, you must have seen a lot of robo-advisors. So a lot of these robo-advisors are kind of an offshoot of your efficient market hypothesis. So in the semi-strong efficient market, you kind of like create efficient frontiers, and any efficient frontier is a bucket of stocks that says, okay, well, if I do this, then this would be the result. And if you produce a number of efficient frontiers, then you can start placing people with different risk profiles into a certain efficient frontier. And that's what a robo-advisor is doing. So as you go in, robo-advisor asks you a number of questions that will identify your risk profile. And once that risk profile is there, they will be able to identify a certain efficient frontier for you and assign you to that efficient frontier. And you will keep on investing every single small little dollar that you give to the robo-advisor would keep on going to that particular efficient frontier every single time. And if you change your risk profile, all the robo-advisor does is switch the efficient frontier from the one that you were using to the other one that fits the new risk profile. And voila, there you go. So the robo-advisors. Now, moving on to the Islamic finance and some of the Sharia compliance. That's a very wide and very tricky topic. So I would try to just be on the surface of the whole thing. So we studied this and we realized that there are a number of challenges that Islamic finance and Sharia compliance faces today. Number one is awareness. So if you just look at a total of 1.5 billion or more Muslims around the world, and because of the taboo that was created around investment and around putting money to work for you, they really were never encouraged to be aware of what was on offer, what could be presented. So once the awareness is there, even when people are aware that that is there, the adaptation is missing, where they would fail to adopt because of this or that in terms of context or pretext or emotional notions or advice from past experience or wherever the background is coming from. So when you have across these two and you say, okay, well, I am aware and I am willing to adopt to invest here, then it comes to, okay, well, how do we know that this is correct? Or how do we know that this is following a certain way of how this should be done? Because we in general in Islamic finance are missing a standards organization in the world. So there is no single standards organization where you go and you register and you say, okay, well, I am going to be a business that would be doing these particular things, and I want to be registered with this particular organization because I would be compliant to these strict principles. And I want to know that these will be valued correctly when I get registered with this standards organization. So that standards organization is missing. Then in the absence of that standard organization, a few people went out and say, okay, well, we want to do Islamic finance and we want to offer Sharia compliance and Wahid Invest, Amana, a number of those funds, they all got created around serving the same need of the underserved Muslims with Islamic halal Sharia compliant investment. Where they all lack is the qualification mechanism. So they all have, in the absence of the standards mechanism, have their own qualifications that they really have to take their investments through. And then they say, okay, well, either I am compliant or I'm not compliant. And because of that qualification looseness, some are saying 5% alcohol is okay. Some are saying 37% riba is okay. So because of that looseness and qualification, you do not get quality Sharia investments today. Then going on to, because of this loose qualification, anytime you want to tighten it, you lose diversity. So most of these funds are invested primarily in big cap or large cap US tech. So if US tech goes down, a lot of Sharia compliant investment goes down. And that's because the diversity kind of like lacked, and they say, well, if you just look up the NASDAQ 100 Sharia compliant and look at the components, the 9 or 10 currency pairs are the only Sharia compliant that NASDAQ is saying. So if you have a fund that is following the NASDAQ Sharia compliance, then they are really invested in currency. That's really pretty much it, nothing else. But if they are going with Amana, then they are going to be 70% into the big cap tech, that sort of a thing. So the diversity lacking is one of the issues that pretty much across the board, all the Sharia compliant investment today faces. Then there is backing. So we are missing in terms of Islamic finance. We are missing good big backing from any of the national governments. So if one big 10 government, like top 10 of the capitalist government, any of them come says, or maybe the top 3 or top 4 of the Islamic governments come and says, okay, well, our treasury from here on is going to run on Islamic finance rules only, then you would have a certain backing and attraction. So a number of these things that I mentioned here, those are the current challenges that Islamic finance faces. And we are me and Rehman are in the process of kind of solving some, or not solving, I would say addressing some of these challenges in a way where they would become a little bit more transparent in choice, and a little bit more quality conscious in terms of qualification of what qualifies to be a good investment for, let's say, for a masjid's endowment fund. And a lot of people donate to masjid, and a lot of masajids have a lot of endowment funds that are sitting. The same endowment funds for the churches and the synagogues are never sitting. They always have a registered investment advisor or somebody advising them. They always are issuing bonds onto themselves, and people then purchase those bonds or those shares instead of investments, and they kind of like have their tax-free benefits as well as growth onto the mosque or onto the religious center they are attached to themselves to. So with that, I will try to attend to the question here. What is the reasonable time to rebalance long-term passive investments, every few quarters or yearly? Okay, so when I look at that particular rebalancing mechanism, I look at it from the perspective of your time frame. So if your time frame is let's say a longer time frame, if you are looking at 25 years to retirement, then rebalancing only comes when you're thinking risk averse in that, ignoring the time frame. So for you, if I were you, I would be 100% small cap ETF. So no rebalancing necessary whatsoever for a very long time frame, because really I'm always 100% small cap, because I know over the time frame that I have, 25 years, my small cap is going to beat pretty much everything else out there. So if you are nearing your retirements and you have a certain portfolio which is 30, 40, 50, and you have to monitor that particular ratio very closely, then obviously I would say that at least every year, if not every 6 months. But rebalancing is something that would ensure that your returns are in line with your risk reward.
Somebody's asking what rebalancing is. Rebalancing is that when you have to shift your portfolio to a certain direction. As I said, we were discussing about bonds and equities. So if you have to move that, or within the equities or within the bonds, you have to move from depending on the risk capital and time frame, you have to move the capital. Yes, so that is one thing. Another question, somebody asking, what is the market? Sorry about that. We should have discussed that. We thought the markets are just an auction mechanism, basically, where buyers and sellers come together in a regulated space, which is regulated by the regulators in the different countries.
Actually, I think it's a very, 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 very good question. The markets, understanding of the market really lacks. So there are two types of market. There is a primary market and there is a secondary market. In the primary markets, the only people who are participating in that market are the issuers and the people who are getting directly from the issuers. So let's think about your mutual funds that you own in your 401ks and stuff. Hello?
Yeah, we're
Yeah.
listening.
So your mutual funds and stuff that you own in your 401ks, they are always being issued in a primary market to you. So you would put an order into the day, but that never gets executed till the day closes, and then the mutual fund knows, okay, well, how much is my share today after the close of market, and then they will take your money and they will issue you the share. But mutual fund is directly issuing you the share. That's the primary market transaction. Our regular markets, your NASDAQs, your NYSEs, your pre-market times and your market times and your after-market times, this is all a secondary market. In the primary market, there is never an auction mechanism. There is a fixed price, and you pay the fixed price and you get it. In the secondary market, it's always an auction. So it is not about the product that you're getting or selling. It is about the person that you're getting or selling it from. There is always somebody else on the other end of the spectrum doing the bid or ask. So if you consider it that way, then in the secondary markets throughout the day, what is happening is at least 50% human, if not more. So if that kind of like explains a little bit about the markets to you.
And then there's a question from Ahmed Malik. What us the advice on when?
Okay, I can explain it. Some of us are not good at investing. I mean, that's not our forte. And at what point do you advise us to have a financial advisor? I mean, you know, it's at some part of our life, we would be like, okay, this is a bit too much to manage. What is your recommendation on that?
Okay. My recommendation is that now that I have gone through what I had been missing in terms of getting educated, if it was to me, I would have a financial plan before I graduated college. So if I failed to do that, I didn't have one, but yeah. I do encourage my kids to have one now. Now that I understand that how big of a difference it could have made. So from that perspective, you need to have a financial plan and or an advisor as soon as you can afford one. A lot of times, if you are under $1 million investing, then you will always be on a fee-based advice. So if you are, let's say, investing less than, say, $10,000-$15,000, then maybe that advice is costing you another $1,000 a year, and you think that it is maybe not worth it or something. But just in terms of a pure savings alone, that advice can make on a $10,000 portfolio, that $1,000 advice is most of the times worth it. So yeah, that kind of like gives you a perspective of in terms of time. I would put a dollar value to it, that as early as possible is the choice for that.
Rahil, we're out of time now. How are we doing on the time? Should we carry on?
I think we can take a few more questions and then call it a day. Okay. There are a few questions that are in the chat if you want to answer those.
Okay, so the first question was
mutual funds are also available as ETFs, especially Vanguards. Which one should we choose in terms of tax efficiency? Consider passive long-term investment with a regular day job salary. Okay, so when you are talking about Vanguard ETFs and mutual funds, if they are a passive index-based investment, then ETFs usually are better tax advantage than the MFs are, just because the capital gains and the other things are not distributed to you at the end of the year. So that tax efficiency is really inbuilt into the wrapper of ETF itself, if that answers your question. So if you have a passive long-term investment and you can choose an ETF, it's better. But also, if you have a regular job and you are going to use a 401k or one of those retirement vehicles that your job is offering, most of the times they would not allow ETFs in there. So you would only be allowed a mutual fund option. That would probably be the only option. But yes, they are changing, and because a lot of mutual fund companies are completely converting to ETFs directly, because that saves them a lot of compliance costs towards the end of the day when they don't have to distribute your capital gains, and they can just keep it there and they can just keep on trading on that. So from that perspective, maybe mutual funds if you want some income at some certain point in time, and ETFs if you do not want any income and you want capital growth as well as some tax efficiency. Okay.
There's a Sharia compliant mutual fund GPF 200. So far the returns are good. So what's the question? The GPF 200 is regulated by which authority?
Okay.
I think GPF is the Global Iman Fund, right?
Yeah, I think
Yes.
I have not looked into GPF, but I will look into it, and I will look into the authority. So the 3 or 4 that I was looking into, there is something called Islamic Finance Group. I looked into that. I looked into Amana. I looked into Wahid. And I looked into Aghas, the robo-advisor that was on our group the other day. And I looked into the text of Mufti Taqi Usmani, the original book on Islamic finance, on how he defines some certain sects. So, but the GPF 200, I'm not really aware of.
If it is SEC registered, then it's regulated by SEC, right? But I'm not sure where is it registered, so we can check that. That's no problem.
Yeah, I think Global Iman Fund is a mutual fund, so it's probably maybe Global Iman Fund is, I think, Canada-based fund, so maybe that's why you're not aware of it.
Okay.
Yeah, it's a Canada-based fund.
All right.
So yeah, so that is something that we are kind of like grappling with these days. That a lot of us are kind of like missing out on some of the quality investments that there are. There are some folks out there that are saying that, okay, well, we'll do fund replicating. So let's say that if you want to follow a star fund manager and you want to invest with them, but you are aware that, okay, with that particular fund, there are going to be bad investments within the fund choices that I do not want to be invested in, but I do want the fund. So what this particular site does is that they say, okay, well, we will take out the bad investments and we will give you a list of the rest of the good investments, and we will charge you $149 for giving you the list. So that's another business model that somebody is doing. So I kind of like found it a little bit laughable that something like that.
I have a question. So if I want to invest in some stocks or some ETF, how can I know that this ETF or this stock is Sharia compliant? Like for mutual fund, I know like there are some companies who are offering it, like you mentioned. But when it comes to ETF, there are so many. And is there any good source
And that was one thing that I was kind of mentioning, that from my own perspective, the research I did, especially from if you look at it from the fiduciary duty of somebody who's looking at from the ethical side of the house and saying, okay, well, if this is saying Sharia and this is saying I'm compliant, then what are they following and how? So that's where I find a number of things that are lacking. That are saying that, hey, 5% alcohol is okay. I say no percent alcohol is okay. So they're saying 37% of riba is okay. I say no riba is okay. So
yes, I think the criteria for giving has to be transparent, and then what we believe that those transparency has to be very evident, and then it should be able to give the investor the choice based on those parameters to choose their investment. So that's the model we think is a better model, rather than putting it under the hood and making a translucent kind of criteria which maybe or maybe not suitable for the people. So people should have a choice. People
should have a choice, and and from that perspective, any single mutual fund out there today and or ETF that is saying that we are halal or Sharia compliant are not looking more than one level down, and are definitely not looking one level up. So so if you have a Walmart and you say, okay, my Walmart is not in the business of making alcohol, so as long as they sell less than 5% alcohol, I'm okay with Walmart. Okay, so that is how most of the ratings are kind of like in terms of halal and Sharia compliance are working today. They are not going to look any subsidiary of Walmart, whether they may be directly making beer, and
Uh,
they're not going to look even one level up. If Molson Coors owns 51% of Walmart, then whatever money you put into Walmart has gone to Molson Coors 51%. So those criteria are kind of like loose. It has been loosened a lot because a lot of non-Islamic folks were kind of in the driving seats for those investments when they were getting qualified.
There is another thing I was reading on when I was actually opened an account with them. So they were saying that previously they were invested in McDonald's, but since McDonald's also sells bacon, so they then withdraw it later on. And they were also saying that there is a purification method as well. Like you mentioned that 5% of, for example, they are investing in a company who deals less than 5% in alcoholic business. So it's then very hard that you find those companies who are purely Sharia compliant. So maybe I think this is a good methodology that if you purify by giving back to the charity or taking out that percentage of profit. So what's your take on this?
Okay, so that's where our foray comes in. So that particular aspect of it is very true, and it is so because people do not want to spend the kind of resources that financial analysis of really true Sharia compliance or finding a true Sharia compliant company would be. Okay, now if you look into the empirical evidences, whenever a financial crash has come, if your company was in very little debt, if your company was doing or was ESG or in terms of those values, your company survived. Your company performed very well in terms of bad areas. So if you just look into that and say, okay, well, maybe I am okay if I make my qualification strict and I would have lesser companies that are truly Sharia compliant instead of making this criteria relaxed and have more companies available. So if they have, let's say, 1,300 companies out of a total universe of 4,500 companies registered in the US today that they are saying that they can invest in, maybe once you have a stricter Sharia criteria, you will only have 200 companies. Okay, but out of those 200 companies, you still can have about 20 buckets of 10 companies each. And then depending upon the business cycles, you can switch among those companies and still have a very good return. Now, it really depends upon, okay, well, what do you think is okay in terms of that? A lot of people say, okay, we are never going to invest, but they don't invest, but they still keep saving accounts. When the money comes as interest into the saving account, they say, oh, when we have received the interest, we are going to give it out to charity. And is putting interest money into charity that was already received by you I don't know. It's one of those questions that is out there, and I really am not anybody to make a judgment call on that. But that's really where that is, right? That same thing.
Yeah.
Somebody makes 5% of alcohol.
My thinking is that, right? Then even the money which people keep in the savings for many years, they are taking the risk of losing the buying power on that money, right? So that's where we think it has to be very well thought of. That money, even though obviously interest is a big topic, right? And even our finance ministers in Pakistan few years back say कुछ गुंजाइश निकालें इसके बारे में भी. लेकिन the question was
in fact the president was saying
the president said कि कुछ गुंजाइश निकालें इसके बारे में. The point is
another thing is that actually so you listed those companies who are Sharia compliant in this business, but then there is another catch, like I think 30% or 35% of your assets, like your debt cannot exceed 30 to 35%. I think
Yes.
this is also one of the.
They put it 37% at some agencies, 35% at some agencies. But and then also, if you go back to the text of Maulvi Taqi Usmani, he says if you were spending a business, the business was legit, but in order to do the legit business, you had to take on debt in order to do that business. That is okay. So
It's a very complicated, like for a layman user or for a person like who are not from a finance background. I think we need something like maybe a watch or watchdog like who
Yes,
verify
a
and
standards
list.
organization that registers and monitors the compliance of these organizations to Sharia or to Islamic investing in order to have a list available. So yes, obviously that was the third point, that we are lacking a standards organization. So we are kind of like pulling out some of the things and seeing, okay, well, what can we do and what can we not. So our next foray is hopefully an ETF, a Sharia compliant actively managed ETF. That is what we are kind of like progressing towards and kind of like putting blocks into play.
So like right now in North America, is there any like good organization, or you think that is better than, not ideal, but better than like 4 or 5 organization who is publishing a list of those companies and who are actually having a regular check? Like,
right.
Do you find any?
If you look into that, at least what I was kind of like able to do, so that there are usually 2 or 3 mechanisms that most of these organizations are using. So they would say, okay, well, we are going with this particular rating agency. That rating agency is usually doing a number of other things. As a side note, they would probably be doing some Sharia compliance ratings too. So there is a rating agency. Then there is a criteria that these companies or investment companies use by themselves on top of the rating agency that says, okay, well, we have gone with this particular criteria on top of this rating agency in order to see this, or we look at the 8Ks or whatnot. But the agency that is issuing the rating is already saying that, okay, well, we are looking into all the filings and everything into this agency and or into this particular thing, and then we are saying that this is grade A Sharia compliant or grade B Sharia compliant or grade C Sharia compliant. So they have graded the compliance itself.
Okay, I see. Okay. And okay. Another question is that, like you mentioned, the interest part. So some people, like they have a real estate, like they have a house and then they take out the equity and like you can take as a loan from your bank and then they reinvest in the real estate market. So what do you think? Like some people say that like the first house or your house is a shelter, so there is a gunjaish, like so that you can do it.
आपकी बात तो ये देखो भाई कि जब बात आती है religious वाली, when it comes to religion, then you have to have a religious scholar that's going to give you that particular advice, right? Now, when it comes to finances, because people were in the need, because the need existed for people to be able to buy the houses, and somebody had to give them the money. And this particular demographic was resistant in getting the money because the money was coming with the interest.
Yes, so, and especially in Toronto market, like the houses are already over $1 million.
Yeah, so the finance market built the interest into the product and sold you the product with the interest already in there. So the price of, instead of the future value of my investment, that would be today, and then with the interest, it would be a certain thing. So I take that future value and I make that the present value, and I say, I sell you the house at this value. Okay. That is also same thing as the zero coupon bonds.
Okay.
So a zero coupon bond at the maturity at 20 years would be $1,000. But today you are going to wait for 20 years for that to mature. You might be sold a zero coupon bond for $300, $400. So a lot of people who are risk averse in terms of saying that who are interest averse, who are saying that we do not want any interest income, they will buy zero coupon bonds, and they will wait for 20 years. In 20 years, when the kid gets ready to go to a professional college or something, they would have a zero coupon bond maturing that they would just supply to that kid, and there is no interest involved there.
Okay.
So,
So Salman, let's wrap this up now. I think we are already way over time. So Qasim, to answer your question, I think now there are a lot of Islamic finance companies like starting up in North America as well, like look into Manzil and other kind of like Zero Mortgage and other type of companies as well. What they're doing is they're just buying the house in full on your behalf and then renting out to you, and you are basically buying equity. So look into those companies. I know we can go for this session for hours, but we have limited time. So thanks Rehman and Salman for giving your time today, and thank you Rehman for even joining all the way from UK. So the FAST and your Alumni Association really appreciates your time and effort in holding this webinar, and thank you all the participants for joining as well, and please provide your feedback. We'll be uploading this video on the YouTube as well. Thank you all.
Thank you so much.
Thank you very much, everybody. Allah Hafiz.
Allah Hafiz.
Yes.